So royalty finance is effectively very long-term capital. We like to call it long-term participating debt. And the way that we participate is typically through the revenue performance of the underlying businesses we invest in, hence the name royalty finance. And I think it's important to point out that we participate both in the upside and the downside, which is a powerful message for the companies we invest in. Why would companies seek it? I think there are a few advantages of royalty finance when we compare it to both debt and equity. Predominantly, I would say that the key advantage versus debt is the fact that because we are long-term investors, so we don't ask for our money back, we're funded through permanent capital. There isn't any short-term refinance risk or heavy amortization, which means that companies can retain cash flow in the short to medium term and invest that in growth. Versus equity, I think the main attractions really are the fact that we are non-controlled investors. So we, unlike private equity, don't come into the business and sit on the board and tell the management team how to run their business. Right, so Duke Royalty is generally looking to invest in established businesses. So we don't invest in startups, early stage businesses. We also don't invest in certain sectors, typically sectors that are very cyclical. So if you think about oil and gas, retail, biotech, those types of sectors are ones that we avoid. But generally we are relatively sector agnostic. We generally look for businesses that have a long history of profitability and positive cash flows, and importantly, we want to take a minority of those cash flows as the lender. So what that means is that we will look for a coverage ratio of at least 2 times the cost of our funding, and typically the terms are we invest over the long term, so we're investing over 30 years, so very long-term capital. We have a roughly 13% cost of funding in year 1, and then that will adjust each year based on the underlying performance of the business, either up or down, usually capped at plus or minus 6%. And importantly, the companies always have the option to buy us out. Yeah, so we're looking for businesses that are of a certain size. I mean, we are looking to invest roughly 5 to 15 million pounds per investment, which means that we need a business that has the EBITDA or the operating cash flow that can support our funding. In addition to size, we're looking for businesses that have a long track record of profitability. We look for the quality of the incumbent management teams as well as the second-tier management teams, because we're long-term investors. We want to ensure that there is sort of a long-term succession plan in place. Generally speaking, we like businesses that are in niche sectors or businesses where there are high barriers to entry. And again, we're looking for businesses where there isn't a high risk of obsolescence. I think the really great thing about our business and businesses like ours, and there is certainly precedent for this if we look at the North American example, is that there is great operating leverage in these types of businesses. So we're receiving monthly royalties, so a very, very predictable cash flow stream. With the team that we've got in place now at Duke, we can very comfortably double, probably triple the size of our portfolio without investing much more heavily in our operating cost base. And so what that means is that with this growth in top line, in cash revenues, and a fixed cost base, it becomes significantly more generative from a cash flow perspective. What that means for investors, of course, is that there is a much bigger pool of cash flows to pay out in the form of dividends. And so we would expect that our dividend payout ratio would continue to be relatively high, and of course with higher operating cash flows, that means higher dividend yields to our investors, and ultimately with yield compression, capital gain.